Well, welcome back, Michael. It's great to have you again. I'm looking forward to chatting.
Hi, Simon. How are you?
I'm very well, thank you. Maybe if we could start today, I'm loving some of the disconnection out in the market. I am scratching my head trying to work out what's going on. Gold's at all-time highs. Equities have retraced a lot of what they've lost. Copper's up there. Iron ore is at highs. Talk me through what's going on.
Great opening question. It's quite hard to articulate. I think in some ways, I had a look this morning at gold's back over $1,800 and actually, I think its all-time high was back in 2011 of around about 1,920 or something thereabouts. Copper prices you mentioned, they're actually up about 5% for this year and have recovered about 48% off their March lows this year. So I suppose if you look at gold as a traditional safe haven asset and the fact that it is on its highs for the year, part of me thinks, well, if people are that concerned and want to plough into gold, more risky assets are most probably struggling. But then you look at equity markets and that's clearly not the case. So if we look at the S&P 500, it's only down 1% for this calendar year. So where it started on January 1, we're only down about 1%. The NASDAQ is actually up 17% this year in the US. Now, part of that is obviously the contrast between technology stocks that are seen as being more of a COVID beneficiary than other sectors in the broader sectors in the S&P 500. But when you look at those all together, normally you'd see gold as a sort of more risk-averse, safe haven asset, or a hedge for inflation. Well, there's no inflation at all. Equities sort of higher up the risk curve, but actually both have rallied quite strongly together. So I suspect part of it is just there's such a flood of liquidity, and I guess it's got to find a home. And that's one thing. And also, I guess, with interest rates virtually at nothing, the fact that gold doesn't give you a coupon or a return like a dividend or an interest coupon when interest rates are virtually nothing and a lot of companies are cutting dividends, that most probably doesn't matter to people. So, yeah, that's sort of what we're seeing.
And I was reading an article that was saying that the bond markets are sort of highlighting that the equity bulls are incorrect. What are your thoughts around the bond side?
I don't know if they're highlighting that the equity markets are incorrect. I think, again, what you'd see in some cycles historically would be equity markets rising. That means economies are stronger, and you'd often see that corresponding to a potential rise in bond yields. You could also see that because people switch out of bonds and buy equities. So it's not unusual to see when equity markets are buoyant that bond yields are actually rising. You're not seeing that at the moment, but I think we need to bear in mind that, one, you've got cash rates virtually at 0 or 25 basis points in most major economies, and central banks saying that they're on hold for at least most probably the next 2.5 years. Added to that, you've got central banks, certainly if you look at Australia, targeting the 3-year bond yield. So there's a buying program where the RBA are really targeting a 25 basis point 3-year bond yield. So I guess, again, you've got some distortions going on from central bank activity and fiscal stimulus. So again, that historical sort of connection that you may expect to see between bond yields and equities may not really be that relevant at the moment.
And on the back of that, the volatility has gone out of the markets as well around the commodities side of things?
It's certainly reduced a lot. So if you look at the, say, major commodities or currencies, to say the Aussie dollar, the volatilities has dropped dramatically from where we were even 4 to 6 weeks ago. And it's a far cry from where we were in late March when the Aussie dollar got down to just above 55 cents. It's sort of hard to believe. And we're effectively really now at where our pre-COVID sell-off commenced. So the Aussie started the year around 70 cents and we're about 69.80, I think, when I looked this morning. So, yeah, it's almost when you look at that, you look at the S&P only down 1% this year. If you sort of came in now and you hadn't been awake for the last 6 months, you'd sort of think nothing had happened.
And
That's not the case.
That could be further from the truth.
Yeah, exactly. So I think markets are getting, I suppose it's human psychology. When you hear something the first few times, the shock value and the fear factor is a lot greater because it's new and unexpected. I think now people hear about the World Health Organization saying this is a long way from finished, the pandemic, we've got record daily numbers of infections. People seem to go, oh, okay, take that in their stride. Even what we've seen in Victoria the last few weeks and the 6-week lockdown in Melbourne, the greater Melbourne area, the Aussie dollar hasn't really reacted at all to that. We had an initial sell-off of maybe 0.5 cent and we're now straight back up again. So I think people have just become a lot more attuned to it. And even though the numbers are pretty horrific, markets seem to be taking everything in their stride at the moment.
And what are you seeing on the business? Oh, sorry. What are you seeing on the business confidence side of things, Michael? I believe there was the NAB business survey that came out just recently.
Yeah, NAB business survey came out this week, and we've also got the Westpac consumer sentiment this week and the unemployment numbers, which will be interesting. I think the business conditions that the NAB published this month were still -7. Now, that's a lot better from -24 in May, and I think we had a low of -34 in April. But people need to bear in mind they're still well below average. And I think the survey is really showing that businesses are still very reluctant, not just to hire people, but also to invest. So the CapEx data in that survey was also negative and pretty weak. And we've still got a lot of excess capacity in the economy. So capacity utilisation's around about 76 in June. Now, it did get down to 72 in April, but where we are now is still about 5.5 points below where we were in 2018. So you've got weak forward-looking CapEx or investment sort of projections. You've got pretty weak overall conditions. You've now got this second sort of lockdown in Melbourne and risks of that happening in Sydney or parts of New South Wales. So I think that says the business sector is going to remain pretty subdued and cautious, and I think that's going to be a massive determinant or headwind for employment growth over the next few years. The other interesting thing with that survey that came out, the data this week, is again, sector by sector, there's quite a discrepancy. We talked before about the difference between the S&P and, say, the NASDAQ and different sectors. Retail and mining are doing quite nicely at the moment. We mentioned that there's been quite a good rebound in a number of commodity prices, particularly base metals, iron ore, but even some of the other commodities some of them are holding up particularly well. Gold we talked about as well. Retail, there's a lot of money going into people's pockets. The Commonwealth Bank had a really interesting release last week showing what's hitting people's bank accounts. And actually, there's a lot more hitting people's bank accounts today than pre-COVID. And even though we've got a lot of people working less hours or people not working, with JobKeeper, JobSeeker, a raft, I think with $750 is going out to about 5 million Australians at the moment. And we saw a similar amount going out to a number of people a few months ago. People drawing on superannuation, $10,000, which you could have done last financial year and this financial year. Ironically, despite everything going on, you've got a lot more money going into people's bank accounts than in February. So that's why we're seeing particularly retail doing quite well, and why we haven't most probably seen the impact we thought we'd have on equities and property and things like that. That for a lot of people, yes, there's been a massive change to your lifestyle. You mightn't be able to go to the pub with 100 people. You mightn't be able to do a raft of things. You're not travelling overseas. But on the flip side, that means you're spending more in Australia if you were going to be overseas. You've got more for a lot of people going in your bank account. You haven't seen a collapse in housing prices yet. Equity markets have bounced back for those that have that. So that's I think making it even harder to sort of really read the economy. There's no doubt though, whilst retail and mining are performing well, and in that business survey came out that way, things like recreation, manufacturing, construction, and those sectors are still weak, particularly recreation, anything to do with hospitality.
And it's interesting, like everything you've just described, I could say from my business perspective is what I see. So from a treasury perspective, it's the same. Volatility, and I say volatility, movement has really slowed down. People are sitting tight. They might want to leave, but they're not going to take a risk. And then, on the back of that, it's probably at record lows in terms of the number of people that are not working. So it's actually, I'm a microcosm of what you've just described, which is right on trend.
Yeah, it's certainly difficult to get a real assessment. I mean, it was interesting. Josh Frydenberg, our treasurer, was interviewed the other night, and he said the true unemployment rate in Australia is most probably around the mid 13% level. And whereas the official unemployment's around 7.1%, but there's been a massive collapse in the participation rate from I think 66% to sort of under 63 in the last few months. So basically, it's a bit like saying the workforce has shrunk by 4 or 5%. And that's meaning unemployment, the way we measure it, is a lot lower. And then you throw in JobKeeper and some other things. So even trying to dissect data like employment or unemployment data is very difficult at the moment because the headline numbers aren't necessarily telling you the true story.
Makes absolute sense. But even more so of a worry around September time, but we'll see what happens politically before we get to there.
Yeah, look, I think with what's happening now in Melbourne and potentially in Sydney, I suspect that they are going to have to be very cautious, and any changes they make will be quite subtle and staged. I don't think the government's going to let things fall off a cliff by just removing everything at once. So that's just going to happen.
No, it makes absolute sense. Well, once again, Michael, it's always a pleasure. Thank you very much, and I look forward to chatting to you next month.
Yeah, thanks very much and have a great day.